let's just jump right into this morning's explainer because the landscape overnight, it just completely shifted. If you're tracking the markets right now, we've got a massive repricing on our hands. We're talking major geopolitical pivots, fresh macro data, and the crucial technical setups you need across major currencies and Indian equities. Let's get to it.
So, the absolute anchor for today's global risk-on vibe? Brent crude. It literally fell off a cliff overnight, plummeting nearly 5% to slip just below that $84 a barrel mark. For us in the financial markets, this is the ultimate catalyst. It completely reshuffles the deck for both equities and global bonds.
And look, this kind of oil plunge doesn't just happen out of nowhere, right? It's directly tied to a massive global headline, a tentative US-Iran peace deal brokered by Pakistan. This framework essentially hits pause on a 4-month conflict. It sets up a critical 60-day window for nuclear negotiations and, crucially for oil, paves the way to reopen the Strait of Hormuz. Washington and Tehran seem aligned on the broad strokes, but you know how this goes. They are guarding the fine print tighter than a central bank's password.
But let's put our trader hats on here. Implementation risks are very real. The actual practical execution of this ceasefire is waiting on a formal signing in Switzerland later this week. Plus, we've still got major regional fault lines. Prime Minister Benjamin Netanyahu just confirmed Israeli forces are staying put in Lebanon's security zones. So the US-Iran chapter might be cooling, but the wider Middle East conflict definitely not fully resolved yet. Markets are going to stay a bit cautious until we see normal traffic actually flowing through Hormuz.
Now, despite those lingering regional questions, Wall Street absolutely ate up this peace dividend. The Dow surged to a record close, the Nasdaq had its best session since March, heavily carried by semis, of course. Meanwhile, Treasury yields fell, dragging the dollar down with them. And then there's gold. Gold spiked over 3% on fading rate hike fears and that softer dollar. Honestly, it perfectly lines up with a great observation from our source material, proving once again that gold rarely minds being invited to every macroeconomic party.
Okay, moving into Section 1, the Global Data Watch.
While geopolitics set the stage overnight, it's the fundamental data that's going to dictate the follow-through. Market participants are going to be scrutinizing this absolutely packed schedule today, looking for any hints ahead of tomorrow's crucial Fed decision. In Asia, we've got Chinese industrial production, unemployment, and investment, plus the BOJ and RBA rate calls. Over in Europe, it's all about the German and Eurozone ZWS sentiment surveys. Then the US session hits us with housing starts, ADP employment, GDP Now estimates, and a 20-year Treasury auction. Every single print today is just another puzzle piece.
Let's talk about the US dollar index, the DXY. We've got a seriously historic dynamic unfolding tomorrow. The FOMC kicks off under Chair Kevin Warsh, his very first meeting as the Fed's 17th chair. And sitting right alongside him, Jerome Powell. That is a wild first. Because of this unique transition, an explicit, aggressive embrace of rate hikes from Warsh seems pretty unlikely right out of the gate, which is exactly why the dollar has been flashing some structural weakness.
Technically speaking, though, the DXY dip did finally get bought up ahead of the Fed meeting. That kept the US 10-year Treasury yield stubbornly anchored at 4.47%, even with that massive risk-on equity rally happening. So your tactical view here is to cautiously buy on dips. You really want to watch those supports closely at 99.64 and 99.00, and keep a very sharp eye on that overhead resistance at the 100.25 level.
Flipping over to the euro, we're tracking the German and Eurozone ZAW economic sentiment prints today. The macro backdrop here is super fascinating. Think about it. If this Iran deal holds and speeds up energy disinflation in the Eurozone, it could totally scramble the ECB's math, drastically cutting the odds of a second rate hike in September.
Because of that looming disinflationary pressure, the structure for Euro-USD remains a sell on rise, though, to be fair, without massive conviction at this exact moment. If you're trading this, keep your eyes glued to the first resistance at 1.1612. More importantly, watch the 50-week moving average resistance sitting right above it at 1.1635. Downside support is currently resting at 1.1544.
And man, this perfectly highlights the total 180-degree reversal in the UK macro story. Markets are now pricing in about 50 basis points of Bank of England tightening over the next 12 months. That's a complete flip from the rate cuts everyone was expecting earlier this year. The BOE is expected to hold steady this Thursday, but that June 17th UK CPI print right before the decision, absolutely critical.
With bond yields easing across the curve and no major UK data dropping today to force a breakout, the pound remains a strict sell-on rise.
you are looking at a very rigid resistance ceiling right at 1.3450. If it gets rejected there, you can fully expect a test of the support down at 1.3393. All right, over in Japan, we are literally witnessing history today. The Bank of Japan is fully expected to hike rates to 1%. That's the highest level we've seen since 1995. But what makes this completely unprecedented is that Governor Kazuo Ueda has been hospitalized. He's only presenting his views to the board in writing. That means this is the first regular BOJ meeting ever held without the governor present, leaving Deputy Governor Himino to chair this incredibly consequential session.
Looking at the USD JPY chart, even with all that historic BOJ drama, the structure remains a buy on dips. But look, we are currently trapped in an extremely tight consolidation zone. Realistically, we need to see a decisive breakout of this tight 159.77 support and 160.55 resistance range before we get any kind of explosive directional momentum.
Moving on to Section 2, India markets and this huge relief rally. The Indian markets basically just enjoyed a rare double espresso shot of good news overnight. The catalysts lined up perfectly. That collapse in oil prices, a massive tailwind. The rupee strengthened for a second straight session, hitting a 5-week high against the dollar, as cheaper oil and RBI measures pulled in fresh dollar flows. Bond markets joined the party too, with the 10-year G-Sec yield easing to around 6.8% on strong foreign buying. Like our source beautifully put it, investors welcome cheaper oil because it's the closest thing markets have to a universal discount coupon. Translating that into the USD-INR chart, the pair ended lower at 94.71, touching that 5-week high for the rupee. The buying interest for the rupee is clearly alive and well. But listen, here is the critical technical level you absolutely must watch, the 94.77 weekly pivot support. A couple of daily closes below that 94.77 mark, that opens up a much stronger sell-on rise structure. For right now, daily resistances are sitting above at 94.92 and 95.21, with ultimate support down at 94.51. Riding that exact same wave of cheap oil and a stronger rupee, the Nifty mirrored all that global optimism. The index rallied by nearly 1%, up 231 points, to close at 23,853. Intraday, it actually blew right past the 24,000 mark before pulling back on some profit booking. This massive upward thrust was heavily fueled by the big players in banking and finance just dragging the index higher. Now, because that intraday break above 23,900 didn't quite sustain into the close, the overall technical structure has officially flipped to a clear buy-on-dips setup. You've got some nicely layered support below, sitting between 23,688 and 23,576. If the bulls can find enough momentum to decisively shatter that key 23,900 resistance, the charts open up a very clear upside target of 24,344.
Which brings us to the ultimate question as we wrap up this session. As you boot up your terminals today, ask yourself this. With geopolitics momentarily cooling down and oil prices handing equity markets a massive discount, which of these upcoming global central bank surprises is going to shatter this fragile risk-on rally first? Is it going to be the BOJ's historic hike or Warsh's big debut at the Fed? Stay sharp out there, watch those technical levels, and I'll see you in the next explainer.